results of our operations over a particular period of time. So this chapter is going to address how we report those results on the income statement. Again, it's best to break down this bigger concept into maybe smaller learning objectives. So the first learning objective is to describe common operating transactions and select appropriate income statement account titles. An operating transaction is an economic event. In other words, it's something we do, buy or sell, for example, to run our business. And we select appropriate income statement account titles because those are going to help us describe those transactions for the readers of the financial statements. An operating activity is where we buy a good or a service from a supplier, for example, or we sell a good or service to a customer. So we have to buy stuff in order to run our business, and we have to sell stuff. When I say stuff, that's either a good or a service, in order to generate revenues to keep ourselves in business. Now, this slide says operating activities include buying goods or services from suppliers and employees because we buy our employees' time and we end up having to pay for that time. So when we buy from suppliers and employees, we actually then eventually have to pay cash or something of equal value. Now, the cycle goes, we buy goods and services, we pay cash to the suppliers at some point in time, so we pay the suppliers either in a promise to pay and then follow up by paying off that account payable, or we pay them cash right when we buy the good or service. And then we sell goods or services to our customers, and we either sell for credit, we call that on account, in which case they have to pay us later, or we sell for cash. And then if we sell on account, we collect that cash at some point in time, but we would debit accounts receivable for the selling amount and credit revenue if we sell on account. If we sell for cash, we would debit cash and credit revenue for the amount of that sale. So in our example that's covered in the text, we have Pizza Aroma, this company looking at representing their transactions on an income statement. So notice on the top where it says Pizza Aroma Inc. income statement for the month ended September 30, 2010. This tells us who the statement is for. That's our company. It tells us what statement it is. In this case, it's the income statement. And then very importantly, it tells us what period of time is being covered by the statement. Remember, the income statement represents a period of time, either a month, a quarter, a year, something like that, and we have to be very specific to designate that period of time in that income statement title area. If you don't designate the period of time, in other words, say it's for the year ended, or the quarter ended, or the month ended, number one, you will lose points, and the reason for that is because that limits the usefulness of the statement. If I'm looking at a scoreboard, for example, and I don't know what period of time that scoreboard covers, that information is not very useful to me. Now, look at revenues. In this particular case, revenues are those things that we earn by selling our product or a service. Now remember, when we earn a revenue, we might get cash right away, or we might have an agreement where we sell on credit and we don't get the cash right away. But in any event, we record the revenue with the credit to the appropriate revenue account, and then the debit part of that is either the cash if we receive cash right away, or accounts receivable if we've just sold on credit. Expenses, these are examples of expense accounts, supplies, wages, etc. Again, we record the expenses with the debit to the appropriate expense account when we incur that expense. If we pay cash for the expense, the corresponding credit is cash because that reduces our cash. However, if we buy on account or on credit, then the corresponding credit is to accounts payable, and then we have to pay out cash later on. So the debit would be to the expense account, and the credit in that case would be to accounts payable. Net income is what we have left after we look at the difference between our revenues and expenses. Now remember, remember, net income doesn't necessarily mean cash. It just means the excess of revenues over expenses. And I say that because normally we're presenting these statements on the accrual basis, which means we record revenues when they're earned and we record expenses when they're incurred. The next slide, we'll look at what we call the cash basis. Now, we'll go to the next slide. Some entities use what we call the cash basis of accounting, but that is not generally accepted in our accounting principles, and usually not the way you will see a financial statement. But the cash basis of accounting, it is when we record revenues only when we receive the cash for that good or service, and we record expenses only when we pay the cash for that item that we just purchased. Our second learning objective under the umbrella of income statement concepts is the matching principle. So what we're going to do in the next few slides is explain what we mean by the matching principle as it applies to revenue. So again, the accrual basis of accounting, which is the basis we use under generally accepted accounting principles, records revenues when they are earned and expenses when they are incurred, regardless of the timing of the cash receipts and the payments. So we can't really say this too often, I don't think. You record revenues when they're earned, and in that case, you either debit cash if you get cash, or you debit accounts receivable if you have a promise from your customer to pay, and then you credit revenue for the amount of that sale. That's the accrual basis. The expenses, you debit the expense when you incur the expense, whether or not you've paid cash for that expense at this time. So you debit expense. If you haven't paid cash yet, you credit accounts payable, which is a short-term liability. If you have paid cash, you credit cash, which reduces that asset. Cash is an asset. So once again, we have this thing called the revenue principle for accrual accounting, which says revenues are recognized when they are earned. Now think about it. If you think about the difference between actually earning the revenue and receiving cash, in other words, the timing differences that could occur. First, we could receive the cash in the same period as the goods or services are provided. And that's how we would record those transactions. Again, depends on whether we immediately receive cash or receive cash a little bit later. Number two, look at the number on the corresponding timeline. It's conceivable that we can receive cash in a period before the goods and services are provided. In that case, if we receive the cash in a different period, we still have to record the receipt of that cash, but the corresponding entry is a liability that would be titled unearned revenue, because we haven't yet provided that good or service, but we have a liability to provide that good or service because we already have the cash. Look at the corresponding number three. We could get the cash, receive the cash in the period after earning the revenue, in which case when we earned the revenue, we would record the revenue with a debit to accounts payable and a credit to sales or revenue. And then in the next period, when we actually receive the cash, we debit the cash to show that we've received the cash, and we credit accounts receivable to show that we've reduced the account receivable now that we've received the cash. Now we're going to apply the matching principle to expenses as well. And again, we have the same type of timeline to refer to here as we think about this. Okay, now, an expense, we record an expense when it's incurred. And the matching principle says we record those expenses in the same period as the revenues with which they can be reasonably associated. What that really means is we incur expenses in order to help us run our business. Our business is to provide goods and services, and we receive revenue when we provide those goods and services. So we try to match the expenses associated with providing those goods and services to the same period that we provided those goods and services. That's called the Manchin principle. Once again, we could pay cash at the same time as the cost or the expenses incurred. That helps us generate revenue. That's that number one point there. We could actually pay cash in the period before, or any period before we actually provide the good or service, and that we would call a prepaid expense. We'll learn more about that later. But a prepaid expense is an asset, so we would debit prepaid expense and credit cash to show that we actually pay cash out, but that we expect to be able to get the benefit of that expense later on. And finally, that little 3 point there, we can pay cash after we've incurred the expense. So if we incur an expense in period 1 but haven't paid for it yet, that's that accounts payable we were talking about earlier, where you would still debit the expense in period 1, and you would credit accounts payable, and then later on, like in a future period, like represented by that little number 3 triangle, when we actually paid for that expense with cash, we would debit accounts payable to reduce that liability, and we would credit cash to reduce the cash. Our third learning objective under this bigger umbrella of income statement concepts is to be able to analyze, in other words, figure out a transaction, record that transaction, and summarize the effects of that transaction using the accounting equation, assets equal liabilities plus owner's equity, journal entries, and T accounts. T accounts are a representation of the accounts in our general ledger. Journal entries are entries we make, as you remember, in our general journal and then post to the different ledgers so that we can keep track of each of our account balances. All of these things use what we call this double entry, the debit and credit method, where we can always count on our debits equaling our credits, and that kind of helps us keep track of what we're doing as we record and analyze our transactions. On this slide, we're going to take a look at a slightly expanded accounting equation. Remember, the accounting equation is assets equal liabilities plus stockholders' equity. And every time we make an entry, our debits equal our credits. That's what the little scale represents. So everything is always in balance. Now, assets, remember, are increased with the debit and decreased with a credit. So everything on the left side of the accounting equation works that way. On the other side, on the right side of the accounting equation, we have liabilities and stockholders' equity. Liabilities are increased with the credit and decreased with the debit. That little reversal there allows things to stay in balance. That's the beauty of this bookkeeping system that was created long ago and helps us keep track of our books. Stockholders' equity, is again increased with a credit and decreased with the debit because it's on the right-hand side of the accounting equation. Now, we're going to divide stockholders' equity, or if you will, disambiguate it with contributed capital as one component of stockholders' equity. Contributed capital, remember, is what we receive from owners or shareholders. And so we increase contributed capital with the credit, we decrease it with the debit. So if we receive an investment directly to the company from an owner, we credit contributed capital, and then on the other side we debit cash, which is an asset, and we would have that entry balanced out because of the way the debits and credits work. Conversely, with retained earnings as well, we would increase retained earnings with the credit, and we decrease retained earnings with the debit. Retained earnings increases every period by the net income from that period. And the net income is the difference between revenues and expenses. Remember, revenues are credits and expenses are debits. So if we have net income, that means we've had more revenues than expenses. So the net difference between those revenues and expenses is net income, and that amount is credited then to retained earnings. If our expenses exceed our revenues, the net difference is a debit, and that net loss would reduce our retained earnings. So revenues, again, are recorded with credits, and expenses are recorded with debits. Okay, now we're going to look at some transactions to get a feel for how those are recorded. Now, I apologize, some of the artwork doesn't show up as I convert these slides into the audio format, but we should still be okay in looking at them. So the first transaction here, transaction A, we provide services for cash. It says in September, Pizza Roma, our company, delivered pizza to customers for $15,000 in cash. So think about it in terms of analyzing the transaction. What happened? We received $15,000 in cash for various transactions delivering pizza to customers. Now, did we earn that that revenue? The answer is yeah. We earned it because we've delivered our good to the customers. So we would want to record that. We know that $15,000 in cash is cash. Cash is an asset. We increase assets with the debit. So we would debit cash when we record those sales. So debit cash and credit revenue. We credit revenue because we've earned that amount because we've delivered our product to our customers. So look at number 3. We see that A here, we record the cash for $15,000 as a debit, so it goes on the left side of the T account. And remember, revenue is on the other side of our accounting equation. It increases with the credit, so the other side of that entry is to credit revenue, pizza revenue for $15,000. So again, the journal entry would be to debit cash for $15,000 and to credit pizza revenue for $15,000. Now let's look at a transaction where we receive the cash before we actually earn the revenue. How do we handle that? How do we record that? Our company sold 3 $100 gift cards at the beginning of the month. So what happens is, do we have the cash? Yes. Have we earned the revenue yet? Have we delivered our good or our service? The answer is no. All we've done is we've delivered a promise to deliver a good or service. So that promise is going to be a liability. So how do we record that? Well, we did receive the cash. Cash is an asset, so we would have to debit cash for $300 for those 3 $100 gift cards. The credit is an increase in a short-term liability that we call unearned revenue for $300. Now remember, by selling those gift cards, we have promised to deliver $300 worth of pizza, in this case, at a future time. So again, the entry is to debit cash for $300 and to credit unearned revenue, which is again a short-term liability for $300. So now we'll look at a transaction where we actually deliver our product, but we don't get paid yet. We don't receive the cash. In this particular case, we deliver $500 of pizza to an organization, to a college organization, and we bill the customer on account. So what happened? Did we get the cash? No. What did we get? We got a promise from that customer, so we call that an account receivable. And we also, have we earned that revenue? The answer is yes. Even though we didn't receive the cash, we've earned the revenue by delivering that pizza. So what we would do is we would debit accounts receivable, that's our asset, and we would credit pizza revenue because we've actually earned that revenue. And now we'll look at how we complete the cycle from that last transaction. Remember, we sold pizzas, but we didn't collect the cash yet on that pizza. Now, in this transaction, transaction D, we received $300 from that organization as partial payment. So what did we receive? Cash. So we debit cash for that transaction for $300, and we reduce our accounts receivable. Remember, accounts receivable is also an asset. So we credit accounts receivable to reduce it by the $300 we just received in cash. And once again, that entry balances and our accounting equation will still balance. Now we're going to look at a transaction where we pay our employees the wages that we owe them for the current month. And so as long as we are paying for wages that our employees have earned in the current month, it will go like this. What do we know is going to happen? We know we're going to pay them cash, and we know that the wages are expenses. They're something we, in air quotes, buy from our employees in order to run our business. So what we end up doing is debiting wage expense for $8,100. Now remember, expenses are on the right-hand side of the accounting equation, and so the expenses reduce our net income, and so we increase an expense with the debit, and our cash went down for the same amount. We reduce an asset with the credit, so we debit wage expense for $8,100 and we credit cash for $8,100. Now we're going to look at what happens when we actually pay for something in advance that we haven't used yet. So on September 1st, the beginning of this month, we paid $7,200 for September, October, and November rent. Now we don't record September rent expense yet because it's the first of the month. We haven't actually used up that rent in September. So what did happen? Well, we paid $7,200 cash, so our cash was reduced, but in doing so, we created another asset that we call prepaid expenses because we have prepaid for expenses that we haven't yet incurred. So what we end up doing is we debit our prepaid rent, which is an asset, and we credit, and because we've increased that asset, and we credit cash because we've decreased cash by $7,200. Let's look at another one of those types of transactions. Here, we pay cash in advance for supplies that we use in our business. So on September 2nd, our company wrote a check for $1,600 for sauce, dough, cheese, and other things like that. So what did we do? We reduced our cash again by $1,600, and we've created another asset, another prepaid type asset for the same amount. So our entry in order to record that transaction would be to debit prepaid supplies, or to debit supplies. We don't even need to call them prepaid in this case because it's just supplies on hand. So we debit supplies for $1,600 to show the increase in supplies, and we credit cash for $1,600 to show the decrease in cash. Now, that when we use the supplies, and we'll see that in yet another transaction, we will have to reduce that supply account and increase the expense account. Also notice, look at the cash account. At any point in time, we could recompute the balance in our cash account by adding all the debits and subtracting all the credits, and the difference would be the balance in the cash account. And that same thing works for any account that you want to look at. So what haven't we looked at? Well, here's a transaction where we incur an expense that we will pay later on. We haven't paid cash for it yet. So we receive a bill for running a newspaper ad in September. Did we actually incur that expense? Yes, because the ad ran this month, but we won't be paying for the bill until October. So what do we have there? Did we incur the expense? Yes. So we're going to have to debit advertising expense for $400. And what's the corresponding credit? We've created a liability by promising to pay, so we credit accounts payable for $400. So again, we debit advertising expense, which reduces owner's equity, and we credit accounts payable, which increases our liabilities. So finally, let's take a look at what happens when we pay cash for expenses that we incur in the current period. In this case, we received and paid bills totaling $600 for September utilities and services. So did we pay cash? Yes. Are we going to reduce cash with the credit? Yes. What did we get for that? Well, we incurred an expense for these utility services. So what we're actually going to do is we're going to debit utilities expense to record that expense, and we're going to credit cash to show the reduction in cash. The fourth learning objective under the income statement umbrella is to prepare an unadjusted trial balance. An unadjusted trial balance is merely a listing of all of the account balances, either as debit balances or credit balances, and then we add them all up and we make sure that our debits equal our credits. That tells us whether or not we made a certain type of error, at least as we were recording our transactions. So how do we get the balance in our cash account? Remember, we add up the debits and the credits, and the difference is either a debit balance or a credit balance, depending upon whether we have more debits or more credits. In this case, the balance in our cash account is $8,100 because we have $8,100 more debits than we have credits. So that shows up in our unadjusted trial balance as an $8,100 debit balance in cash. And in our trial balance, we list first our assets, then our liabilities, then our stockholders' equity, then our revenues, and then our expenses in that order. And you can see that in this unadjusted trial balance. Notice also, as we label this again, it's important to designate the period for this unadjusted trial balance. And when I say that is a trial balance is just a listing of the balances in the accounts at a certain date. And so that's why if you look at the date line on this, it says at September 30th. That's because as of the end of the day on September 30th, these were the balances in all of these accounts. Now let's review revenues and expenses in relation to when the cash is actually received or paid. In the first case here, cash is received before the company earns the revenue. So we debit cash and we credit a liability called unearned revenue. Then when we actually earn the revenue, we debit unearned revenue to reduce that liability, and we credit the appropriate revenue account. Next is a case when cash is received in the same period the company earns the revenue. When that happens, we just debit the cash to increase that asset, and we credit the appropriate revenue account to increase the stockholders' equity. Finally, cash is received after the company earns revenue. So when we actually earn the revenue, we debit accounts receivable, which is the promise to be paid from our customer, and we credit the appropriate revenue account because we've actually earned the revenue, even though we haven't been paid for it. Then, when we collect that cash, we debit cash to show the increase in the cash asset account, and we credit accounts receivable to decrease that asset account, because what we've done now is we've collected the cash, so we no longer have the receivable, but we do have the cash. And now let's look at the expense side. First, when cash is paid before the expense is incurred, we debit prepaid expense, which is an asset, because we have the right to receive whatever benefit we're going to receive later on. And we credit cash to decrease the cash asset because we paid cash out. Now, when we actually use up those benefits that we have prepaid for, we debit the expense to show that we've actually incurred that expense now. And we credit prepaid expense because we've used up that asset. Second case, cash is paid in the same period that the expense is incurred. In that case, we merely debit the appropriate expense and we credit cash. Finally, cash is paid after the expense. So in other words, we have used the benefits, we've gotten the benefits, but we haven't paid for them. So to use the benefits, we debit the expense, the appropriate expense account, and we credit a liability. In other words, we increase that liability we call accounts payable, because that is our promise to pay our vendor. And then finally, when we pay for that accounts payable, we debit accounts payable, which is the reduction of the liability because we no longer owe it, and we credit cash, which is a reduction of an asset, to show that the cash has gone out the door. that's a review of revenues and expenses in relationship to when the cash is received or paid. The final learning objective under this income statement umbrella is to describe the limitations of the income statement. And part of those limitations come from the fact that we are accounting on an accrual basis, so we can recognize when we earn revenues and when we incur expenses, but it doesn't really tell us much about our cash position. So income statement limitations. Net income does not equal cash. So we, in the accrual world, as we've learned in this chapter, net income merely means the difference between revenues earned and expenses incurred. And if we're not accounting on the cash basis, if we're on the accrual basis, net income has really not much to do with cash. Second limitation is net income might or might not reflect real value. Part of that has to do with potential inflation or deflation, but the other part has to do, more importantly, with estimates that are involved in some of these amounts, and we'll get into that later on in the course. And finally, net income is not exact, and again, that's because of estimates that are involved. And once again, we'll look at that both in terms of timing and types of estimates later on in the course. Now, take some minutes and go through the solved exercises in this chapter to be sure that you understand and can apply the concepts that we just looked at.